Welcome back, traders. I'm going to watch another ICT lecture today and give you my key takeaways. This one is titled Weekly Options Strategy Intro. So it sounds like he'll be talking about options, which is similar to futures, but you have more actions that you can take besides just buying or selling. You have to decide if you want to buy calls, buy puts or sell puts. So it's a little bit more complicated. Also, there is time decay and some other things to consider as well. I don't have a lot of experience with options. I've only dabbled with it a little bit, and that was years ago. But price action is still price action, so I'm interested to see what he has to say. As always, you can help me out by giving this video a like. It's free to like and subscribe if you are a day trader. You can find the original video linked in the description.
This is our June 2025 daily chart for NASDAQ futures. This area right in here. We thought that we could trade up into that here and then reject that and trade back down and reach for this low. Inside of all these wicks in here, I mentioned this in the Telegram channel. When you're looking at price action, it's doing things like this, and we have traded below it, but we're still remaining bearish. What I like to look for is inside that area of long-legged shadows or tails on the candlesticks. Now, above the high of the candle, that's usually called a wick, but down below it, tails, shadows, whatever you want to call it. But when the market trades lower and I'm bearish, I like to know where the consequent encroachment is on the longest of the wicks. If there's multiple wicks in here, or in this case, tails, that's this one here. So if you look at that range from the open down to the low of it, half of that's consequent encroachment. If you note that and draw that out in time, you'll see that that's pretty much as far as the market's going to trade to. It's above that volume imbalance that I mentioned last Saturday before we would get to that premium wick consequent encroachment. Now, why am I calling it a premium wick consequent encroachment? Because the market's down here and trading up to it on Tuesday, Wednesday, then it falls out of bed and aims towards that low I mentioned that we would likely do after getting up into that area. Okay, so the initial draw was this volume imbalance, but because the market is volatile and it can trade through it, it trades to it and to the consequent encroachment of this long-legged candlestick.
So if you have a hard time knowing which wicks to use, you're not alone. And I'm here to tell you that you don't need his level of precision to be profitable. Now, he may go into the lower time frame here and show something very precise, but you can still be profitable even if you don't use wicks. Fair value gaps are much easier to identify, at least for me. And if for you too, then fair value gaps may be all that you need. This is the weekly chart for NQ, and in my market outlook, I told you about this weekly SIBI, and look how price went to 50% of it and then rejected. And then here on the micros, price didn't even reach 50%, so we had divergences on the highs telling you that price is weak. Now you can see that using multiple time frames and just using fair value gaps, you can predict the price action, and you don't actually need to use the wicks if that's something you're not very good at.
In this area in here, I want to talk a little bit about options. The run up into this volume imbalance, and as much as that premium wick consequent encroachment, if we were to anticipate that very run down here, there are things that we can do that are outside the futures market and the CFD market, and it involves the options market. So one of the things I like doing, and what I used to do as a younger man, was look for weekly option plays. And that means that if I can predict real close, it doesn't have to be perfect, but this was the number one reason why I was wanting to know what the weekly high and the weekly low would likely be, because I could take an opportunity and trade options with it. Let's assume for a moment that you felt that the NASDAQ futures should go to this area and then trade lower. You could trade the SPX option market. And I know a lot of you like to trade the SPY, but the SPX is actually a little bit better. You have a lot more options in terms of the strike prices. And what a strike price is the determination of what value the option is going to be based on. So for instance, if we were looking at the market likely trading up into this area and then becoming bearish the rest of the week, we could look to sell call options above this area here. Now, I want you to think about how when we're looking at these higher time frame daily moves, when we're spending time on these time frames, when there's a likely intermediate term or long term high or low forming, that presents this very opportunity where we can sell the option. Now, let me make sure you understand this clearly, because the writer of the option has a whole lot more risk than the purchaser of the option. So, for instance, let's say that you were going to, and let's say this is the SPX market, the cash market for S&P. The idea would be that you're trying to pick a strike price above where you think the market's going to turn and start trading lower. Now, ideally, if the premiums, like the put the call ratio and options tools that suggest when there's an overvaluation or an undervaluation, and I'll talk a little bit about that when we get into it next week, a little bit more detail. But for now, I want you to think about how you might be interested in seeing the opportunity of selling call options. Now, a call option is the right, but you're not obligated to buy the underlying. And that means if you're selling call options on SPX, what you're saying is you're giving the opportunity for someone that wants to buy a long call option. And if they buy it and it goes up, they potentially have the right to exercise that and purchase it, but they're not obligated to exercise the option. But they have a limited risk, meaning that whatever they paid for the option itself, that's the most plus the commission costs. That's the most they could ever lose on the transaction. You, on the other hand, don't have that protection. You have a little bit different risk paradigm there. So I want you to think about how there is absolutely inherent risk to this, but when the market's predisposed to go higher or lower on an intermediate term basis, what do you think that purchasers of call options above these highs on Tuesday and Wednesday of this week that just passed, how do you think they feel right now when we're just sitting way down here? Their call options are becoming cheaper. They're getting less likely to be profitable. And with the effects of like theta and time decay, it could really be diminishing over the course of just a few days.
Okay, so a lot of terms you may not have heard of if you've only been trading futures: strike price, calls, puts, theta, time decay. I don't think he's going to define any of these in this video. I know a little bit, but I can't really explain it thoroughly right now. So you'll have to go and do your own research, but let me know in the comments if you want me to do a separate video explaining the basics of options trading. If there's enough interest, I'll be willing to make an educational video for you guys going over this as well as the amount of risk. But remember, this is the daily chart you're seeing here. So this option strategy that he's talking about, you'll likely be holding for multiple days.
So with that, I want you to take a look at how the market has traded on a weekly and daily chart. And you're framing these types of setups on those two time frames. You could write options. Now, the option writer is the person that is taking the option itself to the market and saying, okay, here's what I'm willing to take the other side of. And when there's a buyer of that strike price of that instrument on that very vehicle that you're trading under, and we're going to be looking at SPX options is what we're going to be looking at. The joining of those two parties, the buyer and the writer, he or she collects the premium paid immediately upon the transaction. So let's say, for instance, that you felt that, and then say this daily chart was not NASDAQ, but SPX, the cash market for S&P. If that were the case, and let's assume for a moment that the options above this high here for SPX, say that the options were valued at, I don't know, I'm just going to give you a ballpark number, and it may or may not have been accurate, but let's just say it's $500, okay, per option based on a strike price higher than that high. You could collect the immediate premium paid by the option buyer. So there's people out there that saw it running up like that, got excited, and maybe thought, wow, it's going to keep going higher. So they buy call options. Now, if you're picking a strike price on an option, and a strike price, like say this is where we were trading at on Tuesday and Wednesday of the week, you could have the 600 level. That would be an example of like a strike price. Okay. And it's usually in SPX, it's every 5 handles. So the next one would be below it would be 595, and then 590, and then 585. But basing it on SPX, not NASDAQ. And I know some of you are thinking, well, you should be showing this on an SPX chart. I don't want to be doing too many things in this review. I'm worn out, I'm uncomfortable, and I'm trying to get through it as best I can. But if you were to sell those options by writing them. This is what you're doing. You're the underwriter of the option, basically. So the premium paid by the buyer of that call option, you get that immediately deposited into your account. Now, if you're wrong, that quickly evaporates. Okay, you could see very, very harsh debits to your account balance if you're really wrong and you're selling a lot of options. But the premise is that you're trying to do one. Okay, you're going to start with everything in every endeavor. You're going to start with just one. So what you're looking for is an opportunity each week to sell one option, whether a call option or a put option. A call option is the right to own and purchase the underlying instrument, but you're not obligated to buy it. So you can walk away and whatever you paid for the option and plus commissions, that's your total investment. You cannot lose any more than that. And it's very intriguing. It's very enticing for people to want to do that. When you're purchasing long puts and long calls, and a put option is the opposite of a call, it means that you're likely to profit if the market does in fact drop lower than your strike price. Now, the easy way to remember is call up, put down. Okay, so if you're bullish on the market, you can be buying in a long call. But if you are able to look at the marketplace and time when the market is no longer likely to be short-term bullish, like we had on Tuesday and Wednesday, call options were getting real interesting to street money, retail traders. They want to see a continuation on the upside.
So he was not very clear on explaining everything here, but the main idea is your betting price will go down from here and you're selling to a buyer who is betting that the price will go up. So as the seller, or I guess writer of the contract, the buyer pays you a premium in order to purchase the contract. Now the contract itself can either be a call option or a put option, aka calls or puts. This is the direction that the buyer wants. Call up. So in a call option, the buyer wants the price to go up. Put down. So in a put option, the buyer wants the price to go down. In this example, ICT is talking about selling calls. So we are selling calls to buyers who wants price to go up. We collect the premium because we're the seller, and we're betting that the price will go down against the buyer. So hopefully that clears it up a little bit. I may have said something a little wrong here or there. Like I said before, let me know in the comments if you want an options guide video. But for now, I would encourage you to do more research on your own and then come back here and rewatch this part if you were confused.
So when we're looking at the market likely to go up here, like we mentioned last Saturday, just to go lower, we can wait for the market to get to that extreme when retail will be absolutely bullish and they will be interested in buying call options. But as a younger man, I would be interested in selling or writing call options to the marketplace. So that way I could collect the immediate premium by the buyers of the call option. Now they have limited risk. I don't have the same um, benefits of that. Like I could lose more than I made on the premium. Like it could be worse. It could be really bad. So what you're doing essentially is you're collecting premium by writing the option, and then as the market moves in your favor and against the underlying direction that would profit that call option, their premium that they paid will diminish, which means that you get to keep it. And then eventually, at some point when you're comfortable and you're able to do so, you exercise your side of the option by getting out of it. So you're exiting the trade. You have to buy one. So anyway, I want to talk about how we traded up on Monday into that volume imbalance, and then Tuesday we traded higher into the consequent correction of that wick, and then we broke lower on Wednesday, drawing right back down into this volume imbalance. Now, because the market is predisposed to go lower, we framed it with it likely being bearish, even if it trades back up into this area. We wanted to see it reject it. I think this would meet and agree with anyone's definition of rejecting. I went higher and quickly. So see the time amount of candles it took for it to get there, and then how fast it moved away. That indicates extreme weakness. Now, because it's up here and it's likely to draw down to that low, how can we trade that and not need it to go to that low and lower yet? My expectation is that because we went so hard on Friday lower, we're likely to gap lower than this low here. That's what I'm anticipating. Now, if we don't gap lower and we open a little bit higher, I'll look for it to trade down and then make another attempt to get below that low. Worst case scenario, it reverses on me, and then after a day or two, then it goes lower. That's, in my opinion, less likely, but it's always potentially there because I don't do a lot of holding over the weekend. But in this instance, because it was so likely to get down there on Friday, and I'll talk a little bit about after 4 o'clock p.m. in a moment, but because it's shown its willingness to be so heavy and really no interest in going higher, and it quickly repelled that levels up here. This volume imbalance, I would have never expected to create some short-term low to trade back up. Why? We're weak. We're likely to take out that low here. We have relative equal lows. That's going to be a real quick draw. And then look at this single candle here. And then we had this big down candle here. This is a balanced price range. So it's not likely after creating this candle here, it's not likely to trade back up in this area and treat that as a fair value gap. It's likely to just continue going lower. And going lower it did. And then fell just short of getting right below that low. Now these levels down here, probably looking at them wondering what they are. What I've done was I put a Fibonacci on the highest bodies and lowest body and had projections ran. Okay, and you know what those projections are. But if we get below here, this is the minimum expectation I expect to see. And this is kind of like the perfect scenario for swing trading. That would be a perfect level for me to be content with if it was to trade down there. Now, I'm not going to hold my position that long.
So when looking at balanced price ranges, it's important to note the time and magnitude of candles. For example, here to the left is a balanced price range where price spent a lot of time consolidating. But here, this balanced price range only consists of 3 candles. This down candle engulfed both of these 2 up candles, so the down move is a lot faster than the rally up. In this scenario, the balanced price range is more likely to be respected, so we don't have to expect price to come back to this fair value gap. Instead, on the lower timeframes, we can look for short setups, aiming for this low and this low, which I gave as targets in my market outlook.
Here's an hourly chart. You can see we traded up into that premium wick consequent encouragement on the daily chart. Then we had a lot of displacement lower. We opened on this candle, came right back up to that original draw on liquidity, which was that volume imbalance. Okay, so I only gave you 2 PD rays on that daily chart so that you can track and maintain your awareness or keep your bearings in where we're at in price relative to the daily chart. All the way over here, we see those relative equal lows that I mentioned on the daily chart. There's sell side below that. And then we had another one here on the hourly chart you can see real clear. So this was the volume imbalance on the daily chart that once we moved away from, it would draw down into that. Notice how we did that very thing here to consequent encroachment, which I'm not going to measure, and you can do that on your own chart. And we trade right back up into this inefficiency right here. See that? Now it trades outside of a little bit there into an area that's a balanced price range. So this candle's open to its high, and this candle before it, all that price action back and forth, hits it, stops, and goes the other direction. We have the market trade back down. And then once we get down below the midpoint of this area here, it has difficulty doing what? Going any higher. And it breaks lower. Then we have this sell side imbalance, buy side inefficiency. Trades up into it there. And then it's off to the races we go. Go, go, go. And then sell side taken. Once we took out these lows, it had a lot of heaviness, meaning that it was more likely to continue lower than any consideration of the retracement. There's no need for it to go there. It's in a hurry to get somewhere. Where is that? These old daily lows here. So if we look at how we traded and got right to the close, it was so close. I felt that we were going to at least give me my fill, but it denied me, and that's sometimes what's going to happen. We'll drop down into a hourly chart, same time frame, but we're breaking the days out with vertical lines showing you Mondays, Tuesdays, Wednesdays, Thursdays, Fridays trading. Notice how we had essentially a market maker sell model. Okay, original consolidation, smart money reversal, low risk sell, distribution, redistribution, and then the second leg is the most aggressive to the downside. 15-minute time frame. Here's that blue volume imbalance. And now because we went below it and we're bearish and we're aiming for this low down here and that original relative equal lows on the daily chart, we're going to divide that range up here in quadrants. And now it's going to act as an inversion fair value gap. Okay, so once we leave the upper half and come outside on a closing basis, notice we don't have a closing basis there. But when it does close outside of it, we're then going to watch, does it return back inside of it? And does the lower half maintain price? And does it stay outside the upper half? As you can see, that in fact is what we have. And then we leave it here, we have displacement. This first fair value gap, this is exactly how I teach my inversion fair value gap. Okay, this is the easiest application to an inversion fair value gap from ICT. That first fair value gap that forms after breaking away validating the inversion fair value gap. Once that forms, trading up into it there, perfect. That's exactly what you're looking for. And you place a stop just above consequent encroachment. That would be your underlying risk. Fair value gap that forms after the validation of the inversion fair value gap, that's when you want to start your position. And then any opportunity you can add to it, you can do that. So the market does in fact break lower. It trades down to the first relative equal lows on the daily chart. There's sell side there, and it consolidates a little bit. Then comes and breaks lower again. Immediate rebalance, breaks lower and drifts right into almost filling me on Friday and almost taking out that old low on the daily chart. Here's a 1 minute chart here, and I kind of like want to talk about. I got a lot of questions asking me how did I trust that the market was going to make this type of move here after the 4 o'clock regular trading hours close at 4:14. Usually, if you're a prop firm trader, you're using these monetized demo accounts. These ideas of trading past 4 o'clock, I believe, I'm not sure if it's still true, but I believe at least one of the companies were, I think the rules are you have to be out by 4 o'clock. And that's true. You never get these types of movements here, which in this case, because we're so close to that old daily low when everything's bearish, the market's going to wait until 4 o'clock close and that bell starts ringing. But then you have 15 minutes of settlement still. And then during those 15 minutes, you get to 4:14, right when the new 1 minute candle would open up. That's the closing bell. You're done. Regular trading hours closes. But electronic trading hours are still going until 5 o'clock. So you have 45 minutes still trading. And then you have that hour break until 6 p.m. Eastern time. When the market's really predisposed rather to move lower, many times it'll have this little bit of a Judas swing going into the 4 o'clock hour. And then after 4 o'clock, it really starts to accelerate into a target higher or lower. So it acts like a market on close algorithm where it knows that the majority of individuals are not participating right now. If they're day trading, they got out. They're too afraid to hold over because usually it gets real quiet and listless. It doesn't give you a whole lot of price movement. But when it's so close to an old daily low like that, and we're in a very bearish market Friday, this is when I'm anticipating that type of run. So I'm going to hold on to it as long as I can, even if it's the last minute, because I've done this before where I got basically the low of the day and I was aiming for that very thing on Friday and it just simply didn't give it to me. And it's okay. But these levels here, you can see them on the fib. If you put them on that, you're looking at it over the view of the highest wick down to that lowest wick. And that projection lower, that's negative 0.5. Then you have -1 and then -1.5. This is where I believe that we're going to open at or below. That's what I think we're going to aim for on Sunday's opening. It's a guess. It's not scientific. It's just a hunch. It's just experience speaking, and I'm probably wrong. So don't hold me to it. Not that you can do anything with it anyway. You can't position yourself ahead of Sunday's opening, but that's what I believe is going to happen. But I kind of wanted to talk a little bit about that here because I know that most of you are probably prop firm traders, and you probably won't be able to participate in some of these things. And when there's earning weeks, you'll never catch these types of continuations either. And usually that's how it happens as well. But I think that's going to be it for this one. I'm kind of worn out, and I'll catch up with you, Lord willing, on Monday. Until then, enjoy your weekend and be safe.
Okay, so I went ahead and let him talk to the end of his video. It was interesting to hear him talk about prop firms and their close by the end of the day rule. I never really thought about it, but yeah, I don't really understand why that rule exists. What's the big deal about holding overnight? Yeah, you can say it's like trading news where it could gap a lot, but some prop firms, they let you trade the news and you still can't hold overnight. So I don't really understand it. If any of you know why, let us know in the comments. But not too much to note here. He's gone over inversion fair value gaps before. If you go back to where he talks about the market maker sell model, I actually thought he was going to say power of 3 on the weekly candle. I said it before, I see power of 3 much easier than market maker models, but that's pretty much it. Overall, this lecture was below average for me. I don't trade options, but still I wish he would have gone more in depth with some of the options trading. But I guess he's saving it for future videos. I didn't really get any new insight from this lecture. The best thing was price closing below a fair value gap to validate a inversion fair value gap. It's nothing new, but still nice to be reminded on when inversion fair value gaps are validated. But I hope you enjoyed this video and I got something out of it. Make sure to help me out by giving this video a like and subscribing for more videos like this. And until I see you next time, safe trading.